Hi, everybody. This is the investing teacher, high school science teacher, teaching others how to invest. Wanted to welcome everyone to 2023. I'm going to do in this video more of a vlog type post on how I plan on growing a $15,000 futures account and try to get it to at least 2% a month with gains. I'm going to be also adding contributions in as well, and the system I'm going to use to help grow that account. If you look at my previous videos, I did how to grow a 10K futures account. It's going to be pretty similar, but showing how to scale it up to higher amounts in 2023. If you like this video, please like, share, subscribe, all that good stuff. Helps out the algorithms and all that stuff. And let's just get right to it. All right, first let's go over the 10K account that I started around early October. And looking at 2022 was a very good few months. In October, I did have a 10K account, and the October profit was $1,062. The November close was $1,291.50. Really high gains of 10% a month. The December close profit wasn't as much, but I'm still pretty happy with it. These are all the closed low delta strangles I had. I did have to close an ES part of the delta strangle on the call side when the market shot up. But in the end, I did take in another 182 in a covered strangle, and the net close profit was 157.50. So not quite the 2% I wanted that month. Not the end of the world either. When you look at the last 3 months, I'm definitely very impressed with the gains that we've had. So here's some ways I'm going to try to grow the $15,000 account. At this point, it's about 2,400 in gains, and I added in about $2,400 as well. So I'm going to be adding contributions as well. Here's my blog post on it, and there's a link in the description down below this video if you want to read into more detail. So at the beginning of 2023, I have approximately $15,000 in the Tasty account, and I'm going to be selling futures options to grow it. Now, the goal of this will be to grow it at least 2% a month. So if it's $15,000 and 2%, I'm looking to try to grow at least $300 a month into the net liquidating value of the account. That's if I wanted to just close out everything and take the cash out. Okay. I also plan on adding at least $500 a month into contributions. We're going to be investing into our Roth IRA first. Me and my wife, 6,500 this year. They went up to 6,500 instead of 6,000. That comes first. Then pay up, make sure every bills are paid, no debts and whatnot. And then we will look into adding into the futures account. Based on our budgeting, we should be able to save at least 500 a month into this futures account as well, and possibly more. By the end of the year, we're going to add 6,000 then. It's 500 times 12. Total account will be about $21,000 of just contributions without counting the gains from last year. If I could make about $333 a month, that's a pretty close average to 2% a month. Obviously, in the beginning of the month, I'm going to be at a lower account size of 15,000. Ideally, by the end of the year, it's going to be near the 21,000 or so. Okay? So the primary strategy we're going to be using is selling very low delta MES strangles. We're going to look around 0.03 to 0.05 delta. And then we'll typically look at around 30. It's a 45 DTE. Could go out to up to 60 DTE at times. And then if we're able to close them at 50% profit in half the trading time, meaning if we do a 30 DTE low delta strangle and we're able to buy it back for a 50% or greater profit within, say, 15 days, it's half the 30 days, then it's usually ideally worth it to do so, because then you get money back into your account. You can enter in a new trade as well. If you're unable to close at that half the trading time, then I'm just going to let them hold until expiration and then expire worthless. Or in the small chance that it could get assigned, I wouldn't mind wheeling them by selling at the money, let's say a call side if I got assigned on the put, or a at the money put side if I got assigned on the call side. Okay? I don't mind taking assignment on these because they're really far away. This is the distribution of possible stock prices. 0.05, 0.03 delta is really near the end of these bell curves. So there's a very low chance that it's actually going to get there. If it happens to drop this much in about a month, there's a good chance for mean reversion where it might at least stay near where it is or go up slightly. So that's why I don't mind selling those at the money really close to the same strike, and the opposite option. So again, if I got a sign on the put, I would sell a call. Now, the next main strategy I'll be doing, it'll be a smaller account in the total 15,000 I'm starting with. Will be about $3,000 in this case, is the covered strangle. And to do a previous video, if you'll check in the covered strangles, my history there, typically start by selling two puts. We're going to sell a 0.15 delta and a 0.1 delta put. We're going to be looking to do these weekly, 7 days to expiration. I already have one filled from Friday that will go until the next Friday, which was the exact same deltas that I just mentioned. If both of these put options expire worthless, start a new one the week after. You just collect your premium. This would easily get your 2% a month if that happens every week. If the 0.15 delta put gets assigned, but the 0.1 delta doesn't, the 0.1 delta put, you would keep the full premium, but the 0.15 delta will get assigned, and then we're going to sell a call against it. It's essentially the wheel strategy on that one contract. But then we're also going to sell another 0.1 delta put, and then I'll be at a lower strike price than the previous one because we got assigned the week before. Might be possibly lowering your average of two contracts that way. If both puts get assigned, then you want to take the average of the two. So you find out what your 0.15 delta strike was, your 0.1 delta strike. Also collect the premiums and subtract that. Divide by 2 to get your average. And then in that case, I'm going to sell two calls a little bit higher than that average cost basis. So then we'll be locking in some profits in the next week if those calls get exercised. And then you'd lose your contracts anyway. So here's a cover strangle strategy. Sell a 0.15 delta put, sell a 0.1 delta put, a little higher in the bell curve here, but I think it's still worth it for the premiums. A little bit riskier than the low deltas, in my opinion, but possibly higher returns. Little flow chart. If I get a sign on a 0.15 delta put, I'm going to sell a call against that contract and then sell a new low delta put. If you get a sign on both, I'm going to average both down, sell two calls near that average. Buying power is a very important case here. For buying power, we're going to use up to 50% of the available buying power. You don't want to go above that 50%. What that means is if I'm starting a low delta strangle and it uses $500 in your initial buying power, you want to leave at least $500 in available cash that you're not going to be trading with at all. Okay, very important point there because we don't want span margins to come against us, and then we would have to be closing possible profitable positions just due to the margin requirements. Now, the low delta strangles in general use about $1,000 in buying power plus the cash. Typically, you'll use up about $400 to $500 in initial buying power. We're going to be doubling that in cash and leaving it on the sideline. That's about $1,000 there. And then the cover strangle uses about $3,000 if you get a sign on both of those MES contracts. When I'm able to sell one new low delta strangle each week, plus the covered strangle, and if I still have about 10,000 left, I'm going to look into the ES strangles. ES strangle does take up a lot of funds though, but if we have enough funds available and we're able to spread out our risk with a lot of regular MES low delta strangles, then we're going to add in an ES there because you get a lower commissions as the potential profits. So the commissions are slightly higher on ES than MES on Tastyworks. However, you're able to get a larger profit. So if you divide those two numbers, it's usually a better percentage there. So when starting out a $17,000 account or so, once I get there, we could add in an ES. I'll use up about $10,000. Then I could go to 4 MES. 10 plus 4 is 14. Covered strangles 3. That'd be about 17,000. From 17,000 to 20,000 as the account grows, I'll be adding in one new MES covered strangle each $1,000 because each contract takes about $1,000. Once I'm at $20,000, I'm going to add in an extra covered strangle, and then we'll remove from a few of those extra MESs that we had and go back to the original of about 1 ES, 4 MES low delta strangles, and then you can go to 2 covered strangles to possibly boost that return there. And then as it grows from 20 to 25,000, we're going to again add those 1 EF contracts every $1,000 gain. This is probably the most effective way that I could think of in order to spread out the risk into many different expiration dates and also be able to have your strike prices to be close to delta neutral in both cases. So again, the strategy is a fairly mechanical one. We're going to be looking at those delta neutral strategies where we're going to try to take advantage of the put side and the call side. The covered strangles will be a bit mechanical at first, selling those 0.15, 0.1 delta puts, but then will be a little bit of technical analysis and thought on where the call side strikes will be. It could be a little bit more bullish. You could go higher in the call side, maybe get some capital gains. If you're a little less bearish and you want to get out of the position, you could easily go lower strike prices and then manage it that way. So if you're interested in following along and growing this account, again, we grew it at 10% the last 2 months and then 1.5% in December, and continuing to try to grow this at 2% a month in 2023. Consider joining tastytraders.com on the Inner Circle yearly and lifetime memberships. I show every trade that I post, exactly when I do it, and then when I manage them and close them. And then we constantly look at different advice on what to do with our positions. So again, I'm the investing teacher, high school science teacher, teaching others how to invest. Everyone have a great 2023, and I'll see you guys in the future of 2023.